Welcome to the Explainer. Today, we're going to pull back the curtain and look past that simple buy low, sell high idea to see how financial professionals really operate. We're going to explore how they use these complex tools called derivatives, not just to guess where the market's headed, but to actually manage and price risk itself.
Okay, let's just jump right in with what is probably the single most important idea from our source material. This quote right here, it's the key that separates how most people think from how the pros do it. While almost everyone is trying to predict where the price will go, professionals are obsessed with a totally different question. Is the risk of that move priced correctly?
You know, for most of us, trading comes down to one question. Is it going up or is it going down? Seems simple enough, right? But that simple binary bet, well, it's a trap. And honestly, it's often the fastest way to lose your money.
So if the pros aren't just guessing which way things will go, what on earth are they focused on? Well, they're looking at the very structure of the market, the hidden costs, the weird opportunities that are baked right into the financial products they use. And we're going to start by digging into the mechanics of one of the most common ones, futures contracts. So what's the real difference between buying, say, an S&P 500 ETF and an S&P 500 futures contract? I mean, they both give you exposure to the index, right? But here's the thing, they behave in fundamentally different ways over time. The ETF, that's simple. The futures contract, yeah, that's got a catch.
And here's the basic trade-off laid out. You've got the cash market, think of an ETF. It's simple. You buy it, you own it, done. Then you have the futures market. It's way more capital efficient because you only need to put up a small amount of money to control a huge position. But that efficiency comes with a price tag. You've got expiry dates and this thing called carry. And that's where the hidden costs like to hide.
And that brings us to something called roll yield. See, if you want to hold a futures position for the long haul, you can't just buy one contract and forget it. It expires. So you have to sell the one that's about to expire and buy the next one. And this process, this rolling from one contract to the next, creates a profit or a loss that has nothing to do with whether the asset's price went up or down. And according to our source, this is where so many people bleed money without even knowing it's happening.
So this roll yield, is it good for you or bad for you? Well, it depends. It all comes down to the market structure. If the market is in what's called contango, future prices are higher than the price today. If it's in backwardation, future prices are lower. And that structure is what decides whether you make or lose money every single time you roll that contract. Wow, okay, this slide just nails it. On the left, you have the textbook theory, right? In contango, the futures price slowly drifts down to meet the spot price. But on the right, well, that's the brutal reality. This chart shows a strategy that holds VIX futures, which are pretty much always in contango. I mean, just look at that massive underperformance over time. That's not because the VIX itself went down. That is the constant, grinding, painful cost of negative roll yield.
So here's the bottom line. When you have to roll your position in a contango market, you are forced to sell your expiring contract, which is now cheaper, and buy the next one, which is more expensive. Think about that. You are systematically selling low and buying high, over and over and over again. It's a constant headwind, like trying to swim upstream, and it can crush a portfolio even if the underlying price goes absolutely nowhere.
Okay, so let's build on that idea and move from futures to options. Because just like with futures, the pros see options in a completely different way than most people. For them, it is not just about leverage. So let me just ask you, point blank, what are options really for? If the first thing that pops in your head is, oh, for making leveraged directional bets on a stock, you're thinking like a retail trader, and you're missing the primary reason professionals use them at all. The real answer is right here. For an institution, an option is, first and foremost, a tool for pricing and trading volatility. Its main job isn't to bet on direction, it's to make a trade on what the market thinks might happen in the future. In other words, they're trading fear and complacency itself. And the price tag on that uncertainty? That's what we call implied volatility, or IV for short. Now, it is absolutely critical to understand that IV is not a forecast. It's not predicting what's going to happen. It's the price the market is charging right now for potential future movement. High IV means there's a lot of fear. So the price of insurance, which is what options are, is expensive. Low IV means everyone's complacent, and that insurance is cheap. So you see, to a pro, volatility isn't just one number. It's this entire three-dimensional map called the volatility surface. And they are constantly scanning this landscape, looking for little pockets where the price of risk seems way too high or way too low across all these different time frames and price levels. Okay, so how in the world do you navigate a crazy 3D map like that? I mean, how do you measure and manage all those complex shifting risks? You don't just guess. You have a sophisticated dashboard that breaks it all down for you.
And that dashboard is powered by a set of risk metrics known as the Greeks. Each one of these Greeks isolates a very specific sensitivity of an option's price. It allows a trader to see exactly where their risks are coming from, their exposure to direction, to the simple passage of time, and of course, to changes in that implied volatility we just talked about.
All right, let's just focus on the big ones here. You've got delta, which is basically your raw directional exposure, like how much you make if the stock goes up $1. Then you have theta, which is the cost of time, how much your option loses value every single day. And most important for our chat today, you have vega. That tells you how sensitive your position is to changes in that implied volatility.
Oh man, and this next point is a painful lesson a lot of new traders learn the hard way. You can buy a call option, the stock can actually go up, and you can still lose money. How is that possible? Well, if that big event you were betting on finally happens, implied volatility can absolutely collapse. We call it IV crush. And your exposure to vega can completely wipe out any gains you made from delta. You nailed the direction, but you got the volatility trade totally wrong.
Okay, let's tie all of this together now. Let's walk through a real-world scenario to see how a retail mindset and an institutional one would tackle the exact same market event, bringing everything we've talked about, futures, options, and volatility, into one example.
So here's the scene. The S&P 500 is sitting at 5,000, and there's a huge inflation report coming out tomorrow. Everybody's nervous, so volatility is sky high. The retail approach? A simple directional bet. I think the report will be good for the market, so I'll buy a futures contract. Simple. The institutional pro, though, they're playing a totally different game. They see that super high volatility and they think, the market is overpricing the risk of this event. I'm going to sell that expensive volatility using options, and I'll structure a trade that makes money if IV just collapses after the news, no matter which way the market goes.
See, the professional's goal isn't just to be right about the inflation number. Their goal is to find a situation where the market is mispricing the risk of being wrong. They've shifted the whole game from what will happen to is the market paying me enough to take a view on what might happen. It's a huge difference.
Okay, so let's boil this all down to the absolute must-knows. And like our source material says, you might want to read this one twice. First, futures are not the same as spot, all because of roll yield. Second, Contango can be a silent portfolio killer. Third, options are volatility trades first, direction trades second. Fourth, the Greeks are your dashboard for risk. And finally, it all comes back to that main idea. Most losses don't come from getting the direction wrong, they come from mispricing the game you're playing.
And really, that's the fundamental question this all leaves you with. The next time you look at the market or you're thinking about a trade, just ask yourself this: am I just making a simple bet on which way the price will go, or am I analyzing the structure, the volatility, and the price of risk itself? Answering that question? Well, that's the first step to thinking like a professional.